Hi, do you want to make money even while you sleep 24/7 with someone working for you around the clock? In this video, we are diving into Binance building perpetual contract trading bots and how it can help you do just that. Today, we compare perpetual contracts with grid tradings, which works in bull and bear markets. As long as you pick the right direction, you can profit. Yes, you hear that right. You can start small and potentially double your money with minimal investments. Of course, high rewards come with high risk, and that's why today we are going to break down every detail so you can consistently use Binance bot to earn regardless of market conditions. So first, we will cover some basic concepts. Don't worry, we will keep it simple so you can grasp them quickly. If you don't have a Binance account yet, scan the QR code on the screen to sign up. Doing so will give you a lifetime 20% discount on trading fees, which is crucial when trading cryptos. And for those opening a futures account for the first time, you can use the referral code WLUA5XI6 to enjoy a 10% discount on fees for your first month. So what exactly is a perpetual contract? Let's break it down. First, you need to understand what futures are. Futures contracts are a type of trading contract that allows you to buy or sell a commodity or financial products at a fixed price in the future. You only need to pay a portion of the funds, called margin, to participate, intending to hedge risk or profits from price fluctuations. So a perpetual contract is similar to a futures contract, but with no expiration dates, which has no settlement dates. Hence the name perpetual. It functions like a future without a settlement dates, meaning the contracts can go on indefinitely. And in the crypto world, going longs and going shorts are two common trading strategies. First, going long, bullish. If you believe the price of a cryptocurrency will rise, you buy it, expecting to sell it later at a higher price and make profits. And going short, bearish. If you think the price of the cryptocurrency will drop, you can borrow the asset and sell it immediately. Later, you will purchase it at a lower price, return the borrowed assets, and pocket the difference. So simply put, going long is about buying low and selling highs, while going short is about selling high and buying low. You can take a position on the coins and decide, I'm betting it will go up, or I'm betting it will go down. You will earn a profit if you go long and the price rises. If you expected the price to fall and go short, you can still profit even when others are losing money. You can also use this strategy to hedge against risk in your existing portfolio. And Binance offers two types of perpetual contracts, coin margins and USDT margins, each with different settlement methods. Coin margin contracts use specific cryptocurrencies like Bitcoin or Ethereum as the margins and settlement units. For example, if you use Bitcoin as a margin to trade a contract, your profits and losses will also be in Bitcoins. Coin margins contracts are ideal in the bull market because at price rise, your reverse increase in values, leading to higher profits. USDT margin contracts use stablecoins like USDT tethered as the margins and settlement units. For example, you use USDT as a margins and all profits and losses are settled in USDT. Since USDT is pegged to the dollar, this type of contract is stable and suitable for both bull and bear markets, making it a great choice for beginners. In short, coin margin contracts settle in cryptocurrency, while USDT margin contracts settle in USDT. Now that we've covered the basics of coin margins and USDT margin contracts, let's talk about course margins and isolated margins. What's the difference between them? So course margins think of your contract counts as a single ammunition depot. When you enter a trade, you are sending soldiers to the battlefield. With cross margins, all the ammo in your depot is available to support your trade. If one trade failed, it can drop your entire depot, leading to a total loss. And isolated margins, here the ammo is allocated separately for each soldier. Only the allocated amount is lost if one trade failed, leaving the rest of your depots unaffected. Therefore, an isolated margin is recommended for beginners because it is easier to manage and understand your funds. You won't accidentally set everything to cross margins and risk losing your account balance on a bad trade. Once comfortable with isolated margin, you can consider switch to cross margin mode. Now let's talk about why people use perpetual contract in the first place. Most traders are drawn to contracts because of leverage. So what is leverage? Imagine you spend $10 to buy a coin worth $10. If the price drops to $9, that is a 10% loss. If you buy it as spot trade, you will still have $9 worth of the coin, but with leverage, say 10 times, any gain or lose is multiplied by 10. So if the price drops 10% with 10 times leverage, you lose 100%. Your $10 turns into $0 as the leverage amplifies your loss. Conversely, if the price goes from $10 to $11, that is a 10% gain. With 10 times leverage, your $10 doubles to $20. Your gains can multiply quickly if you predict the market trade correctly, but the downside is that losses also multiply according to the leverage used. Binance supports leverage from 1 times to 125 times. If you use 125 times leverage on Ethereum and the price goes up by 100%, you will gain 125 times your original investment. Sounds intense, right? But remember, with high leverage, if your margin isn't sufficient, even a small price drop can wipe up your positions, leading to liquidation. So leverage has its pros and cons. Let's dive into another trading strategy, grid tradings. After covering the basic, it is time to get into the main topic. Using a boat to automate your arbitrage through grid trading, the goal is to reduce the risk of high leverage contract trading while still allowing you to profit. I'll walk you through the setup step by step, focusing on how to use your computer. First, go to the Binance homepage, hover over trades and select trading boats. So for here, you will see different boat options. Choose future grades. On the left side, search for the coin you want to trade, such as XRP USDT, which is popular. So just enter XRP and select USDT, click on it. Next, select create manually. You will notice 20 times leverage options which you can adjust. We recommend keeping it below 15 times. The higher the leverage, the greater the potential rewards, but also the higher the risk. We suggest sticking to around 10 to 15 times to avoid liquidations. For example, if you choose 10 times leverage and convert, you will see options for neutrals, long, short strategies. If XRP is in a consolidation phase where the price fluctuations within a range. If you see XRP in the bull market, go longs. If it is a down trade, go shorts. No matter the market conditions, there is potential to profit, but you could still lose money if you choose neutral during the trading market, such as the sharp rise or fall. So when choosing neutral, be sure the market is truly range bound. If the price surge, you may want to switch to short to continue making gains. For this example, I will select neutral. Next, you will see the latest price. Set a price range for your trades, which you can determine using the K-line chart. For instance, if you set a range between $0.59 and $0.65, the bill will automatically trade within this range, allowing you to profit from the price fluctuations. Next, let's explain the difference between automatic and geometric grades. Automatic grades, this is like a sequence of 1, 3, 5, 7, 9, where the price difference between each grade level is the same, while the spacing between each level is consistent. The profit from each grade can vary. We recommend using an automatic grade in a sideways or range market because it tends to generate more profit in these conditions. And geometric grades, this is more a sequence of 10, 20, 40, 80, where the ratio between each grade level is the same. Applied here, a geometric grade ensuring that the each levels capture a consistent profit percentage. We recommend a geometric grades for markets that are trading either up or down, as it can yield higher profits. Let's assume we choose a neutral strategy using the automatic grades. Each grade level has the same price difference, but the percentage gain varies. For instance, if we sell price range with a low of $0.59 and a high of $0.65 and decide to use 10 grades, the profit per grade may be too high. The market may not fluctuate enough within our sell range to hit this grade frequently. To address this, we can increase the grade density. Trading fees could become a significant factor if the grade percentage is too low. We recommend setting the minimum density to around 0.4% to 0.5%. Let's adjust the grade to 19 levels, bringing the percentage to about 0.5%, which is more balanced setup. Next, we set the initial margins, which depends on how much you want to invest. Let's say we invest $15 with 10 times leverage. This means your total trading power becomes $150, effectively multiplying your investment by 10. If your position gets liquidated, you will lose the $15, but returns will be much greater if it is profitable. Then, we need to set the trigger price in the advanced options. First, choose the margin mode, click on it. We recommend using isolated margin mode as we mentioned before, especially for beginners. So just choose isolated here, click convert. The grid trigger price should be set at a point where you expected the market to start fluctuating. For example, if the current price is around $0.62, but you think it will start fluctuating at $0.61, then set $0.61 as the trigger price. And for here, you will see that there are two trigger types, mark price and loss price. The loss price is the market price, but we suggest using the mark price, which is the contract price, for more accuracy. Set your stop loss point based on where you want to assist the trade. If the market moves against you, say below 0.59, again using the mark price is better to avoid unexpected spike due to low liquidity. At the bottom, there is an option to close all positions on stop. If you want to close the boats and stop all trades, selecting this will ensure all orders are cancelled. If you don't select this option, you can manually close the order later. It is a matter of personal preferences. If you don't want to manually manage your trades, go ahead and check this option, which is useful if you're worried about forgetting to close your trades. Once everything is set, click create, and the system will ask you to confirm your settings. After verifying everything is correct, click convert to finalize the grid, and you will see a message indicating that the grid has been successfully created. You can view the both settings and the grid class based on the number you set earlier. The green line indicates buy zones while the red line indicating sell zones. The basic principle is that the boat will buy at each grid level if the price hits the green zone. If it moves to the red zone, the boat will sell. If the price returns to the green zones, it will buy again. This way, the boat continuously buy lows and sells highs, allowing you to profit from the market fluctuations. If you are doing the upside and betting against the market, the boat will perform the inverse actions at specific price levels, but the basic principle remains the same. Because the market doesn't move in a straight line, you may wonder what happens if the price goes beyond the highest or lowest set point. The boat will stop making trades if the price exceeds your set range. It will just pause and wait until the price returns within the defined range. And if you ever ever decide you don't want to continue, you can simply click End. The system will automatically close all positions at the market price and shut down the bots. Now let's examine the grids that's already running. Click on View Details, where you can see how the active grid is performing. You can check its current operations, its running times, and its analyzed returns. You will see the bot's activity, what it is buying and selling, and how it's managing different orders. As long as the market fluctuates within your range, the bot will buy when price dip and sells when they raise, constantly capitalizing on these small movements. Even when you are asleep, the bot can continue generating passive income. Once you've learned how it works, you can try yourself. Keep in mind though that while green trading can help minimize risk, it doesn't eliminate it. Any investment that offers high returns also comes with high risk. Don't believe anyone who says you can earn big rewards with no risk. That is simply not realistic. Finally, a crucial reminder: don't get too greedy and never take out loans to invest. That's wraps up today's video. If you have any questions, please drop them in the comments. That's all for now. Bye and see you in the next one. Thank you.